Welcome to My Best Wealth. I'm Elena, and today I have a question that might challenge your assumptions. Does owning low beta stocks really make your portfolio safer? The answer is more nuanced than most investors think.
I'm Marco, and Elena's absolutely right. Beta is one of those concepts that everyone uses, but very few truly understand. Today, we're going to show you what it really measures, and more importantly, what it doesn't. Let's dive in.
And today we have a topic that's fundamental to portfolio construction. Because the number that's supposed to measure your risk might actually be giving you a false sense of security.
Today, we're talking about beta, the metric that tells you how much your portfolio amplifies market moves. But here's the problem. A stock with beta 0.5 can still lose you everything. How? That's exactly what we're going to explain.
Our colleagues will explain it in depth. Carlos, Laura, take it away.
You know, there is this widely held belief in the investing world. It sounds incredibly wise.
Oh, almost like unshakable financial common sense, right?
Exactly. It goes something like, if I just buy stable defensive companies with a low beta, I can sleep perfectly well at night.
Right.
It sounds so comforting.
Yeah.
You check your brokerage app, the metric says the number is low, and you just assume your portfolio is wrapped in like financial bubble wrap.
Yeah, it's a comforting thought, certainly, but it's also a remarkably costly half-truth.
Really?
Oh, absolutely. I mean, it's the kind of assumption that looks absolutely flawless on a spreadsheet right up until a systemic crisis hits.
Yeah.
And then you are left staring at a red screen, wondering why your supposedly safe, weather-proof portfolio is suddenly in a free fall.
Which is exactly why we are doing this today. We've gone through a massive stack of sources for this deep dive. I mean, everything from heavy academic papers on asset pricing to, contemporary Wall Street analyses.
The real frontline stuff.
Yeah. And our mission today is to take you straight into the engine room of modern finance to unpack beta. We're going to demystify the actual formula, see how it powers the famous CAPM model,
and critically tear down the dangerous illusions that trip up everybody from everyday investors to seasoned pros.
Right. We'll also put this metric through a real-world stress test using assets like Tesla, gold, and Bitcoin. Because this stuff matters to you, the listener.
It really does, because beta is not just some abstract concept for economics textbooks. It's the hidden gravitational pull that dictates how trillions of dollars flow around the globe.
Trillions, yeah.
But trusting this single metric blindly without understanding the underlying mechanics. It's like trying to fly a commercial jet through a thunderstorm using only the fuel gauge.
That is a terrifying image. Let's ground this with an analogy before we get to the heavy math.
Okay, I like analogies.
I like to think of your portfolio as a speaker system. And the broader stock market, let's say the S&P 500 is the audio track playing in the background.
Okay, tracking with you.
Beta is essentially the volume dial on your specific investments. So if the market is playing a certain tune, beta determines exactly how loud that tune blasts in your living room.
That's a great way to look at it.
So if we want to understand how loud the music gets when the market panics, we first need to understand how Wall Street wires this volume dial. Like, what is actually happening under the hood?
Well, the mechanics under the hood are actually quite elegant. At its core, beta measures the sensitivity of an asset's return relative to the broader market.
Right.
To find that out, the math relies on two key statistical components: covariance and variance.
Okay, stop right there. Let's translate that from statistics back into plain English for a second. Covariance is basically measuring how closely the stock and the market hold hands as they move, right?
That's a really good way to picture it, yeah.
Yeah.
It answers a behavioral question. When the market zigs, does this specific stock also zig or does it zag?
Right, it's the directional relationship.
Exactly. But covariance alone doesn't give you the full picture, which is why we have to divide it by the variance of the market.
And variance is just the baseline volatility, right?
Yep. It establishes the baseline volatility of the market itself. By dividing the stock's relationship to the market by the market's own baseline, you normalize the number.
Oh, I see.
Yeah, so because the market is essentially being compared to itself, the broader market's beta is always exactly 1.0.
Okay, so 1.0 is our baseline volume, and from that baseline we get 4 distinct behavioral regimes for any asset you might buy.
Right, 4 regimes.
So regime 1, if a stock has a beta of exactly 1.0, it moves in perfect lockstep. The market goes up 5%, the stock goes up 5%.
Correct. But if the beta is greater than 1.0, it amplifies the market's moves. Think of high-growth tech startups or, aggressive cyclical companies.
So if a stock has a beta of 1.5 and the market goes up 10%.
This stock is mathematically expected to go up 15%.
Wow. Okay, but the catch, obviously, is that the amplification works in both directions, right?
Yeah. Oh, absolutely. If the market drops, it drops much harder. The volume dial is turned up past the baseline.
Right, and the third regime would be a beta between 0 and 1.0. This is what dampens the market's moves.
Yeah, these are usually your large utility companies or consumer staples. The market drops 10%, but your stock only drops 5%.
It feels safe. And finally, there is the rare fourth regime, a negative beta.
Right. This means the asset moves inversely to the market. So the market drops and this asset actually rises.
Okay, so understanding that volume dial is just step one. Why does this matter so much on a practical level?
Well, the reason this matters so much is that beta isn't just a descriptive label. It is the central engine of the capital asset pricing model.
Oh, CAPM.
Widely known as CAPM, yes. This is the most taught asset pricing framework in modern financial history. Wall Street literally uses this model to calculate what a stock's return should be.
Okay, let's put some real numbers on this so we can see the CAPM engine running. Based on our sources looking at the 2024 to 2025 financial landscape, let's say the risk-free rate is sitting at 4.3%.
And that's usually pegged to the 10-year U.S. Treasury yield, right? It's what you get for taking zero market risk.
Exactly. Then we have the equity risk premium. This is the extra return investors demand just to justify the headache of being in the unpredictable stock market instead of holding safe government bonds. Let's peg that premium at 5.7%.
Perfect. Let's run a portfolio through that environment. CAPM states that your expected return equals that risk-free rate, plus your stock's beta multiplied by the equity risk premium.
Okay, so if I hold a low-risk utility stock with a beta of 0.5.
You take your 4.3% risk-free base, and you add half of that 5.7% risk premium. That spits out an expected return of roughly 7.2%.
Okay, 7.2%. But if I jump over to a high-growth tech stock with a beta of 1.5.
You take that same 4.3% base, but now you add 1.5 times that 5.7% premium.
So suddenly, my expected return jumps to 12.9%.
That is the math dictating the price of capital.
Wait, let me push back on that 12.9% for a moment. I mean, that looks fantastic on a spreadsheet, but any seasoned investor knows the market doesn't just hand you a 13% return out of the goodness of its heart.
Definitely not.
You are signing up for stomach-churning drops along the way to get that right. But what does this mean for the person buying the utility stock?
Well, it means if you buy low beta defensive stocks because you want safety, you are mathematically signing up for lower returns.
So the lower return is the actual price tag of that safety.
In a perfectly efficient market, yes. CAPM argues that the only risk you should ever be compensated for is systematic risk.
Systematic risk, meaning?
The overarching risk of the whole economic system moving, which you cannot diversify away. Since beta measures exactly that systemic sensitivity, a stock with a low beta should never magically outperform a high beta stock over the long run on a risk-adjusted basis.
Wow. So there is no free lunch in hiding behind defensive stocks.
No free lunch?
Okay, theory is great, but let's take this out of the classroom. Let's see what happens to real assets when the market goes through a sudden stress test.
Okay.
Let's imagine the S&P 500 suddenly drops 10% in a single month.
Well, we can look at two completely different companies to see how this plays out. Tesla and Iberdrola.
Iberdrola, the utility company.
Right. Historically, Tesla has operated with a beta around 1.5. So in that 10% market drop, the math expects Tesla to plummet 15%.
Yikes.
Yeah. Holding Tesla during a broad market sell-off is essentially holding a leveraged bet on the market. It heavily amplifies the pain.
And that makes intuitive sense, honestly. Tesla is a consumer discretionary company. Its sales rely heavily on cheap interest rates for car loans, consumer confidence, all that.
Exactly. If the broader economy gets the sniffles, a highly sensitive company like that catches pneumonia.
Contrast that with Iberdrola, the massive Spanish multinational electric utility. Its beta hovers around 0.6.
Right. So in that identical 10% market drop, it is only expected to drop 6%.
And why is that?
The reason is foundational to its business model. Its revenues are locked into long-term regulated power purchase agreements. Even in a severe recession, people still need to keep their lights on and the refrigerators running. It is insulated.
Okay, so for a utility company and a car manufacturer, the theoretical math maps pretty cleanly onto reality. But what about assets that are supposed to be a completely different asset class? Like gold.
Ah, gold.
Yeah, according to the data in our sources, the SPDR Gold Shares ETF has a beta of effectively 0.0.
And this is where pristine theoretical math violently collides with human panic.
Tell me about it.
Well, a beta of 0.0 suggests gold has zero relationship with the stock market. It shouldn't flinch if the S&P 500 drops 10%, and historically it does act as a safe haven. But look at the severe liquidity crisis in March 2020. What happened?
Everything crashed, I remember. Stocks, bonds, and yes, gold.
Exactly. Investors were facing massive margin calls. They needed US dollars immediately to cover their leveraged equity positions, so they hit the sell button on whatever they could liquidate, including gold.
Wow.
Zero beta does not guarantee zero volatility when a severe liquidity crunch forces indiscriminate selling.
That's a really vital caveat. The math assumes rational markets, but markets aren't rational in a liquidity trap. And I guess that brings us to Bitcoin. Because if gold is a slight anomaly, Bitcoin is a massive identity crisis.
Oh, Bitcoin is a fascinating case study because it completely breaks the idea of a stable beta.
How so?
Depending on what specific window of time you measure, Bitcoin's beta relative to the S&P 500 has ranged anywhere from 0.3 to over 2.5.
Wait, so if Bitcoin's beta is bouncing between acting like a digital, uncorrelated safe haven one year and then behaving like a highly speculative, heavily leveraged tech stock the next, you literally cannot use a single historical number to predict what it will do tomorrow.
You absolutely cannot. In 2020 and 2021, Bitcoin traded largely on its own internal narratives, totally independent of equities.
Right.
But by 2022, when the Federal Reserve started hiking interest rates, it began trading with massive correlation to the NASDAQ. If you plugged its 2020 beta into a 2022 risk model, you were flying totally blind.
Bitcoin's shifting identity actually exposes a massive flaw in how everyday investors use this metric. People treat beta like a permanent tattoo on a stock, when really it's more of a temporary mood ring.
That is a brilliant way to put it. The idea that beta is a constant, unmoving number is incredibly dangerous. It is a dynamic measurement of a moving target.
Give me another example of that.
Let's look back at Tesla's timeline. In 2020, Tesla was in an absolute hyper-growth phase, largely fueled by massive retail speculation and a really polarizing narrative. Its beta was up near 2.0.
So extremely volatile relative to the market.
Exactly. But fast forward to 2024, the company had matured, institutional ownership had drastically increased, its global manufacturing footprint diversified, its beta dropped down to about 1.5.
So if you are an analyst in 2024 and you lazily pull a 5-year average beta of 2.0 to put into your CAPM valuation model,
you are severely punishing the stock for volatility it doesn't have anymore.
What?
You would be systematically overestimating the required return, which means you would be undervaluing the stock today, potentially missing a massive opportunity just because you use stale risk data.
That makes total sense. A company's beta evolves as its leverage changes, as its business model matures.
And as its investor base shifts, yeah.
That dynamic nature is tricky, but there is an even bigger trap here that we need to talk about.
No.
People look at a low beta and automatically equate it with total safety.
Oh, this is the most dangerous misconception.
Right, because beta only measures systematic risk, the risk the company shares with the broader market. It is completely blind to idiosyncratic risk.
And idiosyncratic risk is the silent killer of portfolios. Total risk is the sum of systematic risk plus idiosyncratic risk.
Okay, unpack idiosyncratic risk for me.
Well, a company might have a comfortably low beta, meaning its stock chart doesn't care what the S&P 500 is doing, but beta doesn't know if the CEO is currently committing accounting fraud.
Oh.
Beta doesn't know if their flagship product is about to be recalled. It doesn't know if a massive class action lawsuit was just filed.
It's like relying entirely on beta for safety is like evaluating a restaurant strictly by the foot traffic on its street, completely ignoring the fact that the head chef just quit and the kitchen is currently on fire.
Exactly. The neighborhood might be thriving, but the internal engine of that specific business is completely broken. That is precisely how wealth gets destroyed. Beta measures the weather. It doesn't measure the structural integrity of the house.
Man, that's a great point.
Furthermore, beta relies entirely on linear regression. It tries to draw a straight line through historical data, but real markets do not move in straight lines.
So it completely misses tail risks.
It misses the rare but devastating market crashes. It misses non-linear financial instruments, like a company highly dependent on convertible bonds. And crucially, it ignores regime dependence.
Regime dependence.
Yeah. A stock might look incredibly defensive with a beta of 0.6 when the market is steadily climbing in a bull regime. But when panic sets in and the market crashes, that same stock might suddenly exhibit a beta of 1.4.
Which is the exact opposite of what you want a defensive asset to do.
Right.
Okay, so knowing that this metric shifts over time and knowing it completely ignores the kitchen fires of idiosyncratic risk, I think it helps to understand how beta naturally clusters across different industries.
Definitely. Sector profiles tell us a lot about underlying business mechanics. Technology stocks typically sit elevated in the 1.2 to 1.5 range due to high fixed costs and big growth expectations.
Makes sense.
Consumer staples, companies selling things we buy regardless of the economy, like toothpaste or toilet paper, they sit lower, around 0.5 to 0.7, and utilities are generally the lowest, around 0.4 to 0.6 because of those regulated revenues we discussed earlier.
But our sources highlight a massive anomaly that completely broke those sector rules. The beta paradox of 2010 to 2021. This absolutely fascinated me when I was reading it.
Oh, it is a brilliant example of how macroeconomic policy can completely warp financial metrics. Following the 2008 financial crisis, central banks kept interest rates near zero for over a decade.
Right, money was basically free.
Yeah, and investors globally were starved for any kind of yield. Because bonds weren't paying anything, massive amounts of capital flooded into utilities and real estate investment trusts, or REITs, purely to capture their dividend yields.
So you had all these aggressive yield-chasing investors piling into what were supposed to be boring, sleepy sectors.
And that speculative capital completely altered the behavior of those stocks. It temporarily inflated their betas.
Oh, wow.
Then, when inflation hit and interest rates rapidly spiked in 2022, those yield-chasing investors fled back to bonds. Those supposedly defensive utility and real estate sectors crashed significantly harder than their historical long-term betas would have ever predicted.
So the metric failed because the nature of the shareholders had temporarily changed.
Exactly.
Which leads right into the specific practical traps that quantitative analysts have to fight against. The first one is time frame sensitivity.
Right.
If you calculate a stock's beta looking only at a 1-year calm bull market, it might look like a Boyo 0.9. But if you widen the lens to a 5-year period that includes a sudden market crash, that exact same stock might reveal a beta of 1.4.
Yeah, and professional quantitative systems handle this through something called the Bloom adjustment.
Bloom adjustment.
Named after Marshall Bloom, who researched this back in the 1970s. Systems will take the raw calculated beta and artificially adjust it slightly toward 1.0.
Wait, why push the number toward 1.0 artificially? That sounds like you're just making the data up.
Because of the powerful force of mean reversion. Over long periods of time, extreme companies tend to become more average. A high beta volatile startup eventually matures, acquires stable revenue streams, and its beta cools down.
Okay, I see.
Conversely, extremely low beta companies eventually take on new market risks or face disruption. The Bloom adjustment acknowledges that a beta of 2.5 today is highly likely to drift downward over the next decade.
All right, let me throw a specific scenario at you regarding another trap. Confusing low beta with low volatility.
Oh, this is a fun one.
Let's say I'm looking at a speculative biotech stock. They have no product on the market, they're just waiting for an FDA approval. And the stock violently swings 8% up or down in a single day based entirely on clinical trial rumors.
Yep, happens all the time.
How is it mathematically possible that a stock that volatile can show a beta of 0.3?
This is where we have to fiercely separate absolute total volatility from market-correlated systematic risk. That biotech stock is wildly volatile, yes, but those 8% daily swings are driven exclusively by lab results and FDA chatter.
Right.
Those specific events have absolutely zero correlation to what Apple, Microsoft, or the S&P 500 are doing that day.
So the broader market could be totally flat, and the stock is exploding upward simply because a trial succeeded.
Exactly. Because its price movements are completely orthogonal to the market, the mathematical covariance is tiny, making the beta very low.
That is so counterintuitive.
It is, but anyone who buys that stock thinking a 0.3 beta means it's a low-risk defensive play is going to get completely wiped out. It is a massive idiosyncratic gamble.
And the final trap is the most systemic one. We touched on this with the gold example earlier. The math of beta assumes a linear relationship that holds steady.
Right.
But history shows us that during massive stress events, the 2008 financial crisis, the March 2020 lockdowns, correlations don't stay linear. They suddenly spike. Investors panic, margin calls hit, and they sell everything at once.
In a true systemic panic, a carefully constructed portfolio designed to have a beta of 0.7 might suddenly behave as if it has a beta of 1.2.
The diversification evaporates exactly at the moment you're relying on it to save you.
Precisely. The correlations go to 1.0.
Man. So, if standard beta is this flawed, if it misses idiosyncratic risk, if it's warped by interest rates, and if it completely breaks down during market crashes, what do the heavy hitters use instead? How has modern finance upgraded the toolkit beyond this one number?
Well, the profession has developed several alternative, highly specific risk measures. One of the most practical is downside beta.
Okay, that makes so much sense just from the name. You measure the beta only on the days the market is dropping.
Exactly. You completely strip away the noise of the sunny days. You only run the regression on the bad days. This exposes assets that look defensive on paper overall, but completely abandon you the second a bear market starts.
So if a stock has an overall beta of 0.7, but a downside beta of 1.2.
It is a Trojan horse offering false protection.
Wow. What about dealing with the fact that markets change moods?
For that, quants use conditional beta. This involves mathematical models that explicitly acknowledge the market operates in different regimes. Instead of a single flat number, the math switches gears depending on whether we are in a calm, low volatility bull market or a panicked, high volatility bear market.
Then there were the FAMA French multi-factor models. I know this is a foundational pillar in modern academia.
Eugene Fama and Kenneth French actually won a Nobel Prize for this because they realized the single CAPM factor market beta was simply not enough to explain why some stocks outperformed others.
What did they add?
They added factors for size, which they call small minus big, and value high minus low.
Take a second to explain why size and value change the math so much.
Well, because small companies are structurally different than massive conglomerates. A small cap stock generally has less access to credit, making it far more vulnerable during a recession than a giant like Apple. And value companies are often priced cheaply because they are distressed. Fama and French proved that two stocks can have the exact same market beta of 1.0, but have entirely different underlying risks based on their size and value characteristics. Standard beta is just blind to that nuance.
And finally, instead of just looking backwards at historical data, there is implied beta.
Yeah, this involves looking at the options market, specifically how traders are pricing put and call options today. You extract a forward-looking expectation of a stock's volatility relative to the market, rather than relying solely on historical regressions.
So you aren't just driving while looking in the rearview mirror.
Exactly.
By using downside beta to warn you about the crashes and implied beta to read the current options market, you can build a dashboard that actually warns you about the road ahead.
Beta is an essential foundational tool. I mean, we couldn't do finance without it. But it must be a starting input to your decision-making, never a shortcut to bypass deep, fundamental analysis of the business itself.
So let's distill this entire journey for you, the listener, in your portfolio. Beta is your volume dial for market noise. It is not a magic shield against total risk.
Definitely not.
It is fluid, it changes as a company's life cycle evolves, it is completely oblivious to the idiosyncratic kitchen fires inside a business, and its neat, linear math shatters when panicking markets send all correlations rushing toward 1.0.
It perfectly answers the question, how much does my portfolio amplify the broader market? It absolutely does not answer the question, is this a good investment?
Which brings us to our final thought. We started this whole deep dive talking about that hypothetical investor who buys stable, low beta stocks so they can sleep well at night, trusting deeply in the mathematics of diversification.
Yeah, the dream.
But we also just explored the harsh reality that during every major systemic crash, correlations converge to 1.0. Everything falls together. So if the entire mathematical foundation of beta and modern diversification assumes that assets will move independently of each other, but financial history repeatedly proves that in the darkest moments, they don't. Is the entire foundation of passive diversification just a sunny day metric? It's something for you to think about next time you check the safety of your diversified portfolio.
Thanks, Carlos. Thanks, Laura. Great explanation as always.
Well, there you have it. Now you know that low beta doesn't mean low risk. It only measures one dimension of risk. As always, we analyze, you decide. If you want to go deeper, at mybestwealth.com we have the full reports where we apply these concepts to real portfolios with all the charts and data.
And one important thing, leave us in the comments which concept you'd like us to explain in the next episode. The best ideas come from you. If you found this useful, subscribe and hit the bell so you don't miss any episode of this series. And remember, this content is educational and informational. It does not constitute personalized financial advice. Take care and see you soon.
Until the next concept. Take care.